Before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to the Loonie Hour, episode 35. As always, joined by the three amigos. We got Keith Dicker with IceCap Asset Management in his another brand new Patagucci jacket. Must be I'll have to get a sponsorship for the podcast here. And Rich Diaz, everyone's Tom Brady of Macro here, Acorn Macro Consulting. Welcome back to the show, gentlemen. I'm here, if anyone's asking and watching on YouTube in my hotel room, I'm in Calgary right now. Your favorite boomer, Keith, is actually going to be here next week, but we're going to unfortunately not cross paths. But I'm in Calgary working on some real estate stuff here. I've had people on the podcast ask me before to sort of talk about what I'm doing here. So I'll very briefly, won't bore everyone to death, but I've just got a small project starting, basically single family house that we're tearing down and converting to a fourplex rental, and then some couple projects on the pre-sale side and helping some developers with. So in and out in Calgary, but Keith, I think, is here next week. Keith, I think you want to get together with some people in Calgary, you were saying?
Yeah, so I'm gonna be out there next week. I'm gonna get together with a bunch of clients that we have, but also if anyone's interested in getting together on Thursday, June 16th for a little hello, you have a drink, whatever, just send me an email or a phone call or touch me on Twitter and we'll connect. So next Thursday, late afternoon, early evening on the 16th, if anyone wants to get together, it's fine.
There it is. Free drinks on Keith. You heard it here first. But yeah, I'd love to, obviously, since we kind of here and we opened up the conversation on sort of real estate side of things, I'd love to open up the podcast this week on that, because there's a lot happening, particularly in the rates and mortgage market. And then we'll kind of expand, as always, across the globe, because we've got some updates from Keith's favorite central bank, the ECB. But let's touch base on what's happening in Canada domestically here, because we had the Canada 5-year bond yield broke out again. It kind of consolidated there over the past couple of weeks. And so the Canada 5-year bond, which again, for everybody's reference, prices the Canada's favorite 5-year fixed mortgage. So if you're getting a 5-year fixed mortgage and you want to figure out, the direction of where those rates are going to be, just got to watch that Canada 5-year bond yield. And that's ripped up to 3.2%. That's the highest reading since March of 2008. I don't have to remind you guys, what happened in 2008, bad things. So not to suggest that that's where we're going here. Not necessarily the same dynamics, but, rates at these levels are going to cause problems, and we'll certainly get to that in the show. But that kind of leads me into my next point, and Keith, I certainly want to get, your guys' opinions on this, but so there was a large Canadian bank. I'm not going to name names. It's not really necessary. There was a large Canadian bank. So when you go to get a mortgage, you're in the market, you're looking for a home. You're typically going to a lender. You're going to walk into the bank or call your local mortgage broker, and you're going to get a mortgage. You're going to get a pre-approval. So you're basically going in. They're going to say, okay, well, you qualify for this amount, and why don't we hold a rate for you? So when you're ready to buy, at least we got to, especially in a rising interest rate environment, let's hold your mortgage rate. And so typically speaking, most banks will hold your rate anywhere from 90 days to upwards of 120 days. And so when we've seen, over the past 6 months, your 5-year mortgage has gone from 2% to, we're almost getting close to 5% now. Having those rate holds has been a godsend for a lot of people. I've had clients personally where, again, those are 90-day rate holds where they're like, okay, we bought a property. Our closing date is, 2 months out. I've had a lot of clients recently saying, hey, Steve, we need to actually move the completion date up, 5 days because our mortgage approval will expire. That rate hold will expire. and will be subject to the new rate, which is, 4.7%. And that will increase our payments by whatever. In their case, it was like $600, $700. So these are like big numbers on a monthly basis. So people are basically kind of scrambling, moving completion dates around. Anyways, one of the largest lenders in Canada, out of the blue, announced that, 90-day rate holds. By the way, we don't care. We just dropped it to 15 days. So they're going to put a lot of borrowers in extremely difficult situations. You can imagine, even if you have a purchase that might be closing, all of a sudden you thought you had 90 days and it's 15. So they kind of dropped the bomb on everyone. And so, Keith, I'm kind of wondering, because my take of this is like, this is not just them saying, hey, let's just do it just for kicks. This is a huge reputational risk that they're taking. And so I think the only way they would do this is if they stand to lose a lot of money. And so, correct me if I'm wrong, but the way that banks tend to offset a lot of risk or sort of fund their mortgages is basically on the bond trading desk, right? So they're sort of hedging rates and hedging their bets to sort of offset some of these, liabilities and whatnot. So, I mean, I don't know if you can expand further on that, because it sounds like somebody dropped the ball on the trading desk big time.
Yeah, I wouldn't say it's on the trading desk. So remember, banks are always focused on their P&L, profit and loss. They do not want to lose money. And the way the banks are structured, there's a lot of moving parts involved with it. They have asset liability teams, risk teams, you name it. And these guys are meeting. It's not like once a week, every day they're watching this stuff. But for them to reduce it, very quickly or suddenly, abruptly, they could foresee something happening, which would hurt their bottom line. They don't care about reputation risk, because I think we all have, really cool bank stories over the years. And you know what? Like, they're still chugging along. I think, I always laugh in Canada, everyone loves to hate their bank, but they still, love their bank at the end of the day. But I don't know if you guys remember, but a couple of weeks ago, all the banks were raising money on the market. So they all issued debt, they issued bonds. Some of them issued USD debt, I think, as well. And, rates have gone up further since then. So yeah, maybe you're right, Steve, maybe somewhere along the line that this bank got a little bit offside, or maybe they have better visibility now than they did a week ago or 2 weeks ago. Because remember, when the banks came out with earnings, everyone, sort of did not provision more for bad loans than what they were expected to. And even RBC had a negative number, So I think this continues to play in with what we've been talking about here, is that it's highly likely, or the probability is increasing, that we are headed for some kind of a slowdown, which will affect bank loan provisioning, what they're lending out with mortgage and all that stuff. But when they do that out of the blue, like, that's not a decision taken lightly. They have a good heart, think about it. And now here we are, we have Steve Saretsky on the Loonie Hour sharing with everyone what's happening.
Well, yeah, I could tell you the industry was kind of like jaws dropped, because like that's not like a normal move. Like, people at competing banks that I was chatting with are like, whoa, that's big news. So
what's the response, Steve? Like, do they pull their business, from the bank?
Well, yeah.
Or
So, I mean,
to get some angry phone calls and then that's all they can do about it? Like,
well, yeah. I mean, you're gonna get a lot of angry phone calls for sure. I mean, like I said, I think there is part of it, and there is an element, I think, of reputation, because okay, for example, if you're just like a mortgage broker, you're not employed by one of the big banks, so you kind of have a little bit more free reign to sort of place mortgages wherever you see fit is best for the client. So a lot of mortgage brokers will go through this specific bank, for example, and if they opted to put rate holds at this specific bank for their client, now all of a sudden, that mortgage broker is probably getting an earful from their client and saying, well, hold on a minute, I thought you told me you held my rate. And so, I don't know, is that mortgage broker going to be compelled to work with that bank in the future when he has 10 different options? So I think there is an element of that relationship that I think was kind of broken, because especially right now, right? Because like, it's not like rates have gone up like 10 basis points. It's like, okay, who cares? Like, they cut it down to 15 days. Like, we're talking like again, there's been a massive move. We've had mortgage rates, that 5-year mortgage rate has gone from 2% 6 months ago to basically next week we'll probably be at 5%. I mean,
Can I ask a better question?
Yeah.
Sorry, stupid question, but isn't that like a legally binding contract? Like when you sign, do you not have? I know. I see. I know.
Not. Yeah. I mean,
do you know what I mean? Like, isn't? I know I'm quite naive. I'll beat Keith to it. Yes. Okay. I'm naive, but like, when you sign the document, isn't there any recourse? There's no guarantee. It's just like a.
What's the old saying? Like a banker will give you an umbrella on a sunny day and take it away on a rainy day. Like.
Sounds like something my father might have said.
Yeah, I just think like that's kind of the case here, which is like, listen, rates are going up a lot. I don't even know. Like, there's been, I think there's some mortgages that are being written or issued that, are maybe not really a money maker off the bat. Just with where rates are going. The other element is, So I just. That's kind of what's going on. I think, like I always say, like, if you look at Vancouver and Toronto, where the markets are extremely levered, like it's really not uncommon for people to go there, young families that have kids that need, larger homes, to have $1 million mortgage. Totally normal. So,
So when did this happen, Steve? Was it yesterday?
Yeah, as of this recording, yesterday. So it'll be Wednesday.
Is this today?
I'm confused. I don't know. We're recording this on Thursday, by the way, for everybody listening at home.
This is where I like to go. This is where I go.
But that
Marty, we got to get Marty back to the future.
Kind of leads me into my next sort of conversation, which again, I'd love to get your thoughts on, which is, so like this happens. And so I immediately get on the phone with one of my really good friends, and he runs a bond trading desk, not with this bank, but with a very large financial institution. So this guy's wicked smart. I mean, anytime I have questions on what's happening in the bond market, I just give him a call. Cause he's sitting there in the seat all day long. So, he's telling me that basically, he's like, if you look at the bond market today, the way things are trading, he says in his simple terms, he's like, in terms of like liquidity in the markets, he's like, if you take the pandemic in terms of liquidity there, like when all hell was breaking loose, liquidity was like a 1 out of 10. He says today things are like a 3 out of 10. So not good, not great. He's like, it's really tough out there. There's a shit ton of volatility. And that's why I'm saying, like, did somebody drop the ball there? But that kind of brings me to my next point, Keith and Rich, which is like, I'd love to get your thoughts on rates markets right now. I know we were talking about, again, this is not investment advice, but like, is there a potential trade there coming up? Just a tactical trade of like getting long, like TLT, the long bond, because like, are rates close to peaking out, or are we going to have one big final rip here before something breaks, before yields ultimately come back down? Like, how do you see this sort of shaping up?
Want me to go first? Rich? Yeah. Rich hasn't said anything yet, except for
I know. Sorry, I've just been looking up nuclear power statistics the whole time.
Rich thinks the bond market's gonna go kaboom with a nuclear bomb.
Listen, I think this is not investment advice, but I think it's weird how stable the 10-year has been. I'd say, given what we've seen about, let's say, consumer confidence, worries about the health of the U.S. consumer, which is the most important sort of household in the world. The yen's breaking down. Was worried about recession in Germany. Oil's at 120. I mean, all this stuff, and yet the 10-year I just looked is at 3.06%. And you'd think that in a world where we're gonna get weaker growth and recession fears, and I mean that's not necessarily my view fully, but something's going on that the 10-year would have already reacted, right? In the same way that you get.
You're saying, just to simplify, you're saying it should have reacted lower, aka it should start pricing in lower growth or recession, where like yields should hypothetically be falling, in your opinion.
Yeah, I'm saying that and to refine it further just a little bit is to say, like, I'm shocked that it already hasn't moved, if that's the saying. I think, in a previous life, in a different cycle, given all the bad news that we've gotten, I would have expected the 10-year to be at 250, you know what I mean? Or whatever, you know what I mean? Not up, or at least flat, despite all of the negative news. And that makes me kind of worried for the Fed. You know what I mean? I think that there's something going on in the bond market that I don't think we've seen in a long time, which is, normally bad news is good news for the bond market. And so far bad news is damp squib. Hasn't changed at all. So do I like the idea of sort of fading that and maybe parking some more money there to just as protection, because you don't really know what's going on and you think risk assets are going to have a hard time? Sure. I prefer, I prefer what my client is the one who actually suggested. He's like, look at the GIC numbers. The short-term debt numbers are actually, I think, really attractive. So instead of taking that duration risk, you take the hit on the loss of purchasing power for sure. But I mean, if you look at the 2-year money, I mean, it's so, the yield curve's flat, right? So you look at the 2-year money, the 1-year money, and you can, and instead of taking that duration risk, you can actually sort of park your cash there and still lose in real terms, but at least, you
got Keith all excited about GICs licking his chops like the good old days.
Like the good old days. Tell us about it, Keith, before the internet.
Well,
GICs
when I was 25, I could get a GIC paying 25%.
My
mortgage
goodness.
was 35%. Okay, so on YouTube, you can see this here, whatever. We see a whole bunch of turning points coming up over the next few months. And these would be trades. They wouldn't be, or opportunities to enter positions several times or several tranches in different markets. But for the 10-year C that you're asking about, yeah, we could see that coming up pretty soon. So for our portfolios, we could be going into the 10-year, like within hours, days, or weeks, or months. So I don't want to give it away too much. But that opportunity is there coming up. But remember, like a few months ago, people were calling for the 10-year to hit, it's going to go to 4%, then 6%, and then 10%, and the US will be bankrupt. And
no, that's not.
As Rich made a really good point, that it seems like the 10-year has hit this, 3% ceiling. And, it's stuck there. Now, a lot of people are really looking at the 30-year as well. So the 30-year is at around 3.2% right now. But the opportunity to make money on that side is pretty big. And what people don't realize in the bond market, when you're playing the duration game or a long dated bond, so let's say you're holding a 30-year bond. To make things real simple, it has a thing called, it's a 30-year duration, or duration is equal to 30. And what does that mean? It really means that if you get a 1% move in interest rates on the 30-year bond, it's going to be 1 times 30, because that's your duration. So if you hold a 30-year bond today and the 30-year yield goes from 3.2 down to 2.2, for in this example, you're making 30% your money. Like, that's pretty good money. Yeah. So people who do trade the bond market, and all of these opportunities, they don't come up very often. But again, like, we're not saying this is one right here, but like all of our models are sort of lighting up that, yeah, we might have this opportunity coming up. Remember, long term, it looks horrible. Like, the bond market is not something that you're going to park your money in, and especially credit markets and high yield debt, emerging market debt. I just don't see that as being attractive. But markets are not linear. They never move in a straight line. And when everyone's on one side of the boat, you got to run to the other side, because I learned a long time ago, it's better to buy low and sell high. But man, everyone does the opposite, because it feels so good to buy at the high, and it feels even better to sell at the low, right? Because it's, things are going. But that's what we see, Steve.
Yeah, no, I mean, I think it's interesting. I mean, I think it's always just to sort of reiterate to our listeners, because people always get confused. I read some of the YouTube comments and stuff, and the feedback that we get, and it's always important to like distinguish like time horizons,
right?
Because everybody has a different time horizons. Like, again, when we say like get long bonds, again, we're not saying hold them for the next 20 years. Like, that's kind of financial suicide. but like it's a tactical trade, for example. And it's just kind of the same thing. Like when we talk about like, again, like going back to the Bank of Canada and saying, well, rates, they really can't like normalize interest rates. Again, like they can go up to 3%, but like, can they hold at 3 for a meaningful amount of time? I think the answer is no, given the outlook, the debt picture. So, but the central banks are kind of fighting this game, which is, this is a conversation I was having with my friend there, the bond trader, which is, I was like, well, man, like if liquidity is at, let's say 3 out of 10, if that's what you're telling me, I mean, he knows better than anyone. So I just listened to him. He says, if it's 3 out of 10, I said, if it goes back down to 2 out of 10 or 1 out of 10, like, does that force the central banks back in when you still have inflation at 5-6%? Like, it's kind of like they're kind of stuck in this, like, excuse my language, I mean, it's a shit sandwich. Like what do you do? And this is kind of like, this is what, Grant Williams calls like the end game, right? Like the monetary policy end game. It's like inflation breaks out and like central banks like can't necessarily run to the rescue because like they're kind of like hand tied. But I think at some point they're clearly going to have to make a decision, which is, do you intervene and help the asset markets out?
Yes.
If equities and housing continue to sell off, or do you like stay true to like your official mandate, which is like 2% inflation? So again, I think we're going to get our answer pretty quick. Certainly, I think Rich and I agree that it'll be the asset holders that will benefit. But
can I just add something, which is I think it's not, things are not linear, and I think also things aren't static either, right? So we've touched on this before, and we're not quite right yet, but I hold out hope. I think in Canada, we've seen the peak of inflation. And if it's not this month, it'll be next month. Again, I've referenced, the producer price index, X energy, that's been really, really good to me over the last few years in sort of tracking where inflation's going. And I think that will change the math for bondholders. I think that, and it's just something that it'll be interesting to see how the bonds and the yield curve react to, in my view, less inflation, or at the very least disinflation, let's say, where inflation goes from 8 to 7, still very high historically, but just the math and the direction are different.
Well, yeah, and I think that's the important thing to also like distinguish to people. Is like, it's funny because like inflation will come down from whatever 7 down to like 5, but like the absolute prices aren't coming down. Like they are still rising. They're just not going up at as fast of pace. So, sort of like the ongoing debasement continues. But that kind of brings me into our next sort of pivot here around the world, which is Keith's favorite, the ECB, because thinking about absolute price levels and crazy central bankers. We had a press conference from the ECB, which I know Keith always enjoys tuning into. Again, Keith, I'd love to get your thoughts on that, because I think I don't know what Eurozone inflation is at. What is it, 8% right now, 9%?
Yeah, it is up at that level. And
rates are negative 0.5, by the way, for anyone that isn't paying attention.
They didn't change it today.
I don't even know where to start with Europe. I call it the economic fantasy land called Europe. And so there's a lot of
We should get some shirts made up, by the way.
Yeah, no, that would be
economic fantasy. Anyways, continue.
Call it Europe. I like that one. Yeah. So one thing that's really interesting one thing that's the ECB is really good at, they're better than the Americans, Canadians, everyone else, and the Brits. Man, they're so good at communicating. Like they're able to say one sentence and it can be interpreted 5 different ways. And they've always been able to dance around everything. And at the end of the day, nothing happens. Like there's no result with it. And, not to offend or support any cultures out there, but when I was working offshore, meetings, we either had a European or British style meeting or the American style meeting. And the American style meeting is like 10 minutes. You go in like, blah, blah, okay, let's do this. And you went and did it. And, sometimes it worked, sometimes it didn't, but you did something. And that's all that mattered. And then we had like the more of the British culture meetings, depending on who was on a different committee and stuff. And my God, like it was analysis paralysis. Everyone had long presentations and they all sounded really smart. They were doing it. And after like 2, 3, 4 hours and then continuation the next day, the meeting was over and everyone would leave. And I'd sit there and I'd look at the guy next to me, like Scott from Winnipeg. And I'd say, are we doing anything? And he said, nope, nothing. There's never anything done. So that's what the ECB is like. They're very good at talking. So what they said today, one, they realized that everyone in the world is raising rates except for the Japanese and the Chinese, and that's a different story. But the Europeans, they had to say, hey, we're going to start raising rates as well, and we're going to start reducing liquidity. That's what we're doing in Canada. It's what the Americans are doing as well. And the best thing was, so the chair of the ECB, or she's the president of the ECB, Christine Lagarde, she said today that, they're going to raise rates in July and September, and they're going to raise rates up to 0%, which is just it's probably...
Rich is laughing right now.
Well, it's like a scene from Monty Python.
I know, it really is. It's probably one of the all-time greatest quotes from a central banker. We're going to raise rates up to 0%. And
it's almost as good as her quote about when they're going to reduce the balance sheet. We're going to do it. When? It'll come down. How is it going to come down? Anyway, sorry. Carry on, Keith.
Yeah, it's like the budget balancing itself.
Yes,
we have up here. Yeah, so they did that, and so by the way, she became head of the ECB for political reasons. You can imagine. There's 19 countries trying to have input into the ECB. Guys, it's not easy. Like the Americans have, a small committee, but one guy's making the decision and that's about it. Like Europe, again, it goes back to that meeting description I just gave you there a couple of minutes ago, right? I can just imagine if you were sitting in on the ECB 2-day meeting and you would just leave at the end either thinking, man, these guys are really super smart, or you'd leave and you'd say, man, no wonder nothing ever gets done in Europe. Like they just go around circles. However,
go ahead. I was going to say, did you see that? I tweeted like 2 weeks ago. It was there was like an interview with Christine Lagarde, head of the ECB. And then there's like all these like students, like, I guess watching, I don't know what sort of seminar conference it was. And so the guy that was interviewing Lagarde on stage put up a chart on the big screen of like the ECB's balance sheet. And the question was, how do we reduce the size of this balance sheet? And she's like, it will happen in due course. But he's like, and then he goes, but when, and how long will it take? And she goes, in due course. And like, it's never, there's no chance that thing is ever getting unwound.
In defense of Christine Lagarde, and you will never hear me say this more than once in my lifetime, there's an interview of Ben Bernanke in 2008, and they're like, so when is the central bank balance sheet going to come down? And he said, it'll normalize eventually relative to the economy. And it's just like, and then they contrast that with, anyway, sorry. I mean, I love the internet.
So wait a second. This is
anyway,
now
go back to Keith's story.
I know, but we now have 2 weeks in a row. Rich, last week he fell in love with Yellen. Now he's falling in love with Bernanke.
It's the springtime.
You're going down the wrong
These ladies
path.
deserve some love. It's the spring.
He's looking for a new job at the BOC.
Yeah, that's right.
The governor.
Speaking of paths, by the way, guys, Rich was in Montreal last weekend. And the score is Rich Diaz 1, Montreal 0.
Yeah.
That was the score. Okay.
My suit is not going to recover. Let's just say that.
I'll leave it to Rich to explain the scoring system on that one. But the other, very important point here with Europe. So the central bank, they are positioning themselves to potentially start raising rates and all that. And even if they, again, put this in a comparison, let's just say the Europeans get up to 0% by September. If the Canadians continue on their path, we'll be at 3% a couple of months later. So that's a huge divide. So even in the FX world, all else being equal, like Canadian dollar, especially because we got oil here, the Europeans desperate need of energy, and they're not going to get it. I don't know where they're going to get it.
From the sun, Keith. Come on, from the sun.
Not looking good. One more point, though.
Wind turbines.
and this is a really important point. It's also come out over the last few days as well that the EU, so the European Union, not to be confused with the ECB, they're already having discussions to put in some kind of a backstop to support sovereign debt that would potentially come under stress if the ECB starts raising rates and everything again. And what I know within my chat groups, it's being geared specifically towards Italy. So again, the crisis hasn't even happened yet, or it hasn't escalated because they already are in a crisis. But with the ECB doing this, the EU is already getting ready to say, hey, again, we need to get ready for this, which is positive because before they were never ready for it and they would do a backstop later, after the event. But Europe is a mess. There's nothing better today in Europe.
Well, even like the IMF was out like 4 weeks ago, like on a public channel saying that, that emerging markets were likely to have, sovereign debt issues this year, that they would need basically bailouts, and the quicker that the IMF could help bail them out, the sooner the better. So like, it's not some sort of conspiracy theory. But that kind of leads into, again, like,
before we get into that, I just want to say I just think we're going to get into this and Keith's going to come over and beat me up, but I think the emerging markets, I think that some countries like Italy and Europe, I think, are in bigger trouble than some of the typical emerging markets that we've seen. The emerging markets have been able to raise interest rates significantly, have in some cases have positive real interest rates, which means they have room to maneuver. And a lot of them sell the commodities that are ripping, and a lot of their government balance sheets are tied to that. Their industries are tied to that. And so it'll be, in other crises, whether it was, 1997 or the Mexican one or whatever it is, and you had these countries that were in a world of hurt. Now you have a situation which Brazil, which is normally a basket case, actually has actually done the right things, has increased their interest rates almost 8%. And so they're actually sort of, for once, ahead of the curve. Now I might live to regret saying that. But anyway, sorry, keep going.
No, I think in a normal cycle that will be correct, Rich.
Yeah.
My view, though, and a view here at IceCap that we put together, is that the probability of a significant financial crisis escalating is a lot higher than people are expecting. And when that does, it touches on, Steve, the point that you made with your mate, the bond guy. He said, liquidity is extremely low right now. And so during a crisis event, you need liquidity. And unfortunately, like, money runs out of the emerging market, or like Brazil will do better on a relative basis than other markets and stuff like that. And then, once everyone is rushed out, you want to go and buy those assets afterwards. My point is that capital loves liquidity, and there's no liquidity in Europe because, the only people holding Italian debt right now is the ECB effectively, and pension funds, because they're forced to buy it. So I just think it's not a market that we're going near. We can't sell it because we haven't held it for a while. But again, people want liquidity. I just think that entire market gets painted with the same brush no matter what. So after it happens, that's when you want, money on the side, and then you can just run in and, fill your boots. It'd be great opportunities.
Yeah. I mean, like I said, it's the hawkish rhetoric continues. I'm just sitting here on my computer, and somebody, on my Twitter DMs here sends me this. So I guess apparently Bank of Canada's Tiff Macklem has a it's their annual financial stability report today. So I guess he's got a press conference. Anyways, Bank of Canada Governor Tiff Macklem asked if households could handle a larger than 50 basis point rate hike, says we may need to take a larger step. So I don't know if that's 75 basis points in July. Keith, do you have the updated sort of forecast there?
Well, I didn't even realize, but since we've been talking, CAD's been coming off a bit more aggressively here. I don't think it's changed too much. Give me a second here. I get they
are still pricing in, by the way, 3% by the end of 2023. That's what the market's pricing in. So
I think
don't know.
end of 22. I think that's where we.
Oh, sorry, end of 22. That's what I meant. Sorry, end of this year, 3%. So we're at 1.5. So we still have a doubling of rates to go, apparently.
So right now it's at 3.25. So it's bumped a quarter point, over the last couple of days.
So these guys are kind of just shooting themselves in the foot, essentially. Markets are basically,
I think just back on the euro raising rates back to zero, channeling their best Monty Python expression. I think it's also important to discuss how screwed some of we talk about Italy and that they've definitely got their problems, but just, and that's maybe more of like an existential problem, a debt haircut problem. That's tomorrow's problem. Today's problem is Germany. I was looking at this the other day, and it's something I completely missed. Germany's industrial production continues to lag, to fall. I was looking at their auto production. Believe this or not, Germany's industrial production, so their output basically for motor vehicles, trailers, and semi-trailers, that's what it's called, is 40% off its peak from 2018. Look at the IFO, which is like a survey of business sentiment. It's continuing to lag. I mean, they might not even get enough. Forget Italy. They might have to deal with a recession this year in one of its most important economies, an economy that's been, the driver of growth in that region for a long, long time.
I was just going to ask you. I was like, is the Eurozone not already in the recession? Like, I guess maybe. Yeah,
I mean, I hate
not officially, I suppose, but
I hate using the R word. But I think it's if it's not there, it's I mean, how do you square something like producer price index? Producer prices have gone something like 20, 25. I think I want to even say almost 30. I'm looking at it right now, 37% increase in producer prices. Yes, I get that that's energy, but energy is an input and all different things. And then on top of that, you've got supply constraints with the manufacturing sector in Germany. And then you got Greece doing super, super well because the euro is really cheap, and they, got rid of all the COVID restrictions really, really early. So for the first time in a long time, that's booming, but Greece is too small to move the needle. So before we might not have any time to worry about Italy, Keith. Well, be worrying about the recession in Germany and France.
One thing, guys, as we talk here, on the magic machine in front of me, I think Steve Saretsky is now out of a job.
Uh-oh.
So the Bank of Canada, Macklin, he just came out and he said the economy can handle, and it actually needs higher interest rates. Here it is. Moderation in housing would be healthy.
Oh.
This guy has no. I mean, I know it's all like political, and they have to say what they need to say to like exude confidence, and
it's credibility. Housing is credibility.
Housing is a disaster right now. Particularly,
so can you explain that though? Because you mean the sales have dried up, the prices themselves have come down. There's no supply in the pipeline. Do you know what I mean? Okay,
home sales in Toronto in May were a 20-year low.
Holy crap.
Greater Vancouver, we're doing a little bit better. We're faring a little bit better. I think we were like 10, 15% below the 10-year average, but sales activities is continuing to slow. As we talked about in last week's episode, in the suburbs of Vancouver, Fraser Valley home sales were down 50%. House prices, I think, seasonally adjusted on a national basis, had their steepest decline since 2008 on a month-over-month basis. And I get it's only a month of data, but keep in mind, rates, as we talked about at the beginning of the show, rate holds, pre-approval rate holds have mitigated a lot of the higher rates actually filtering through to end users yet, right? Rates again have gone from 2 to 5 in 6 months, and a lot of people have been holding rates for 3 to 4 months. So there's a lot of activity that I think is still happening in the market because people are borrowing 5-year mortgages at 3.5, 3.8% instead of 4.8, which is what it's at now. So yeah, these guys are just completely wrong. And it kind of goes back to the original forecast again from from the Scotiabank guys, which is 8 rate hikes. Congratulations. Looks like you'll get it right. But you also said house prices won't decline, which we're a couple months in and they've already started declining. So yeah, I just think the housing market is not built. Like prices at these levels, particularly in Vancouver and Toronto, which are the most systemically important markets in Canada, because they are the largest housing markets and they obviously derive a lot of GDP. They're not built to function on 5% mortgage rates. They're just not, without a material decline in
By the way, earlier when we started the conversation today, we talked about you heard the what's the phrase? The guaranteed rate is held for 90 days. It's been reduced to 15. What do you call that?
We call it a rate hold.
So the rate hold. Again, I'm not in the housing world. So that happened yesterday.
Yeah.
In our Loonie world is tomorrow. No, 2 days ago. Anyway, but my point is that, we're asking like, why did that happen? And now all of a sudden, as we're talking here now, the Bank of Canada has come out with these comments. So, now that I see this happening, it's highly likely that bank knew this was coming. So that's why they've been,
they got a phone call. They got the
nod. They got the nod.
But I have a question, like, why would these guys keep, like, at this point, I feel like everyone's kind of like, like the markets are already pricing in 3, which I think is a lot of tightening by year end. Like, why come out like super hawkish still? Like now markets are pricing in, 3.25. So it's like, I don't really understand the angle. Like, I know that you're trying to.
I'm going to say it. They're fighting for. They lost the appearance. It's not. I've said this before on the podcast. It's not enough that they are independent. They need to appear to be independent, and I think that that's something all central banks have given up, for better or for worse. It might have seemed like the right idea at the time. I don't think it was. Anyways, it's okay. I'm not in that position, but I think that that's what this is about. I think it's about they screwed up. They screwed up on inflation forecast. Fine. Anyone can get that wrong. But I think the worst misdemeanor is that they screwed up on the independence part of their job. And I think that that's, in my view, I think that that's what they're really chasing now. And that to me is that's a dangerous game, right? Because because maybe the right thing to do is to pause for a year and let the housing market settle. Who knows? Find its footing. Let the supply catch up, let the demand recalibrate, and then continue on with rate hikes. But I think that this is my view. Obviously, it's a little speculative, bordering conjecture, but I just think it's about regaining that credibility from a technocratic and independent standpoint.
Well, yeah, I mean,
I have a different view.
Okay, go for it.
I think the red shirts and orange shirts in Ottawa are giving them heck right now, because the blue shirts are using inflation as their, main campaign platform right now. And I think they're just getting raked over the coals. So they're saying, hey, you got to shut this down and shut inflation down immediately. You know me, like I don't think we live in this night cleaned world at all. I mean, we're not there.
The jobs have to come. I mean, keep in mind, going back to Rich's credibility comment, I mean, let's not forget that Tiff Macklem in September of last year was still saying inflation was transitory and was going to subside. In September, national home prices are up like 24% at that time, year over year. So now he's saying that the economy can withstand like, a 3.5% overnight rate is perpetual liar. But yeah, I don't, I mean, what about like the jobs? Because the one things I'm focusing on too is like, I know, I just like looking at the housing market because I just obviously know it fairly well. So I pay attention the knock-on effects, right? So what happens is like, I can just tell you like sort of how like the sales cycle works, and I don't want to bore everyone to death here, but so what happens is basically like, as everybody knows, the media, especially in the developers, which, sort of pay for a lot of the advertising in the media, obviously promote a lot of new supply, right? Let's build, baby, build. And so what happens is the pre-sale market, which developers rely on, basically funds their construction. And so when the resale market dries up, as it does, and house prices start to decline, the investor activity, which drives over 60% of pre-sale purchasers as basically investors speculating on higher pricing, those buyers dry up. So the pre-sale market tends to lag. And so what we're now seeing finally, it's very slowly, like it's not terrible right now, but you're seeing pre-sale launches, sales start to really slow down. And so now the developers are now about to launch are saying, cost of construction is still really, really high. There's still some supply chain issues. Plus now our cost of financing is, doubled. These projects are no longer feasible because we don't think, not only can they not think, but they're not really able to pass a lot of these costs on to the end user because the end user is saying, well, hold on a minute. Like the resale market is correcting. The sentiment is turning sour. Why would I want to speculate on a futures contract here in the pre-sale market? So one of the largest construction financiers in Canada, Kingset, was out yesterday. The head of development saying the industry has already canceled 4,600 units of housing in the past 3 weeks. So I can just tell you anecdotally, a lot of developers are just running their pro formas and saying, nah, let's just hit pause. So again, when housing is such a large part of the economy, and as Rich will throw up his fabulous charts, I think those employed in the construction sector, about 9% of the Canadians employed, roughly 8 or 9, 8% of those employed in Canada are in the construction industry. So as projects hit pause, et cetera, I think that there's that eventual knock-on effect. Again, it's not going to happen overnight, but I think you'll see housing starts permitting.
This is what happens when you have a speculative bubble. This is why, I was looking at a chart the other day. Spain's nominal retail sales only just got back to its previous 2008 peak. And I know that maybe
that's
I'm just
crazy.
too much of a nerd, but that is mind blowing for me. It's why I reference Spain, because Spain has
nominal, not even real.
That's bananas, right? To me, that's an absolutely crazy chart, which I swear I will share. But just to give you, speculative housing bubbles are dangerous because A, the leverage, B, they're tied to people's net worth. Obviously, it sounds obvious to say it out loud, but it's important. And when you have contractions, it really leaves deep scars. Also, you're producing basically non-productive assets. Sorry, Steve.
No, I don't disagree. I'm not, I certainly make my living off of it, but let's be honest. I think everybody is well aware that our housing situation here is kind of a joke. And we enacted policies over the last 20 years to basically inflate it to where it is today. These are policy decisions.
So wait, I have a question though. I have a question. I want to ask both you guys. So what do you think will be not the terminal policy rate for Bank of Canada, but what do you guys will think will be the trajectory? Forget the rate hike 1, 2, 5, 6, whatever. It doesn't matter. To me, I'm more interested in go over the next 6 to 12 months. Do you think that they'll raise a couple more times and then back off because they have no credibility and they aren't independent and they don't want to deal with the housing? Or do you think this is it? They're going to tank the housing market because, as Keith laid out, they're getting a tap on the shoulder from the Liberal Party and stuff like that.
So I'll go first and let Keith answer, but my view is obviously, again, historically, as Rich, as we talked about in the beginning of the show here, is typically they tend to side with asset holders. It seems, at least in the near term, that they're not going to side with the asset holders, and they're intentionally manufacturing the recession. We're already, like I said, we're already seeing it playing out in the housing market. So I'm a bit surprised, to be honest. I didn't think they'd have the wherewithal, what did you call it, Rich? The testicle fortitude
testicular fortitude
to actually move forward with this. But all I can say is, all I know is if they proceed to hit their 3% overnight rate target by the end of this year, housing is in a world of pain.
So the key difference though between the Canadian market today and what the Americans experienced back in 0809, the American experience, the banks had a lot of loans on their books, but they laid off a lot of those loans in terms of mortgage-backed securities, which then, morphed into CMOs and CDOs and all that stuff. So the whole world felt that pain because it is a dollar-denominated market. the challenge with the Canadian housing market is that the mortgage-backed security business is not that big. So the banks are still holding on to a lot of the debt. So if we do experience a significant downturn, it's going to hurt the banks. And the big challenge for Canadians is that we've always been told that Canadian banks are, they're a fortress. They will never, ever experience anything downside. They'll never cut a dividend and all that stuff. And because it hasn't happened, it's not a risk. It's one of those things. A risk is only risky if it happens. So just to lay that out there, right? We do have that risk here in Canada, and it's very unique. The only other country that has the same risk and anybody is even at a higher level, I think, are the Aussies. Yeah. So Canada and Australia, we're both screwed if some kind of financial risk would engulf the world again. But to answer your question, Rich, we suspect the Bank of Canada, they'll plateau with rates Q4, and at some point in 2023, they'll have to start cutting rates in line with everyone else around the world. That's just what we expect to happen. So it does create a pretty good opportunity in the interest rate market.
I'd like to also add something as well. I actually tuned in last week to Deputy Governor Beaudry at the Bank of Canada. So he was like the speech following the rate hike announcement. There's actually some good questions from the reporters for once. I was like, oh, okay. Like it was actually like, so basically there was a couple of reporters. They basically asked them, they said, would you last time inflation was this high, you had to bring out like Paul Volcker and create like basically this like downturn recession. Would you be willing to do that? Would you be willing to manufacture a recession in order to get inflation back down to target? And he basically said more or less, I mean, he kind of jumbled around a bit, but he basically said, yes, but we're aiming for a soft landing. We think, he said, basically his words, like, we think we can engineer a soft landing where we can bring demand down enough without hurting the economy and pushing us into recession. I personally think like there's no such thing as soft landings. Like you're not landing this thing successfully after, expanding the monetary base by 30% in the past 2 years. And you're going to take 30-year highs in inflation and just achieve this magical soft landing, and nobody's going to lose jobs and housing's going to just moderate. Like, I just don't see this. But again, he basically said it. I took his words. I kind of read through what he was saying, which was like, yes, we will manufacture a recession. And so I still think, as surprising as that may sound to a lot of people, it seems to me evident that that's now what they're trying to do.
I think that's outstanding because, again, as a money manager, you don't want to let your feelings on what they should do. So you want to look at, okay, what are they telling you? And we've already expressed our thought that this is what they are doing implicitly. I've said before, the Americans, they want a deep recession that will solve their inflation problem. The Chinese are shutting everything down again over on their side of in their country to reduce demand. But for the Bank of Canada to come out to explicitly state, yeah, we would do that. That's incredibly powerful to know as an investor. Like, it's really cool. In the happy days, kind of cool.
Well, no, I mean, just to kind of wrap this up here, but like basically that was kind of the whole, the whole purpose of the show is really to get people thinking, right? It's not necessarily to give you like trade ideas. It's just to get you thinking. And like, I don't know. I'm in the real estate industry. Like, I get paid off of like a good housing market typically. I mean, I still do well in downturns because I try to like educate my buyers and stuff, but I get paid better in bull markets. And I'm telling you, like, as wrong as I was initially on the rate hiking call, I would humbly admit that I missed the fact that I didn't think they'd be willing to basically engineer a recession. So like, again, when the facts change and the data changes, I think you just have to kind of shift with it. And regardless of what your like emotion is about it or what you want to happen, it's not about what I want to happen. It's like, listen, this is what they've chosen to do. And when that recession comes, let's see how they react, because I still think it's coming. I know, Rich, you hate that word, but
No. I mean, it's just, I don't like people who spend a lot of time predicting it. I think that's kind of a waste of time, but I agree with your sentiment. You know what? I've changed my mind too. I didn't think they had the balls to do it either, frankly. And so it's interesting to So, I mean, that's it. That's it. When the data changes, you change your mind. But speaking of getting people to think, you guys promised I could have a minute, so I'm going to do this.
This is what's that segment we have? It's called Weird Things with Rich. So, Rich, we'll give you a couple minutes here on the spot to wrap it up.
Okay. So, one of the comments in the YouTube. So, first of all, the comments in general have been great. Thank you very much for everybody's support. I was terrified at first to read them because I have really thin skin, but everyone's been really, really nice. And one of the comments was, what kind of assets, commodity price signals, economic indicators do I look at? Basically, the question was, what's my macro model? I don't really have a macro model. If you go on my website, everything is pretty well clear. I've got chart packs. You can see the way I organize my thinking, and that's what this is about. But I do have some words on my framework, which I can quickly share, and how I sort of organize my world. Keith and Steve will have different views on this, but this is sort of the way I've learned, and this has obviously evolved over the years. And if you come find me in 5 years from now, it'll probably change. But at the moment, it's set up in 4 parts. They ebb and flow with respect to what's important when, but in general, you got like a macroeconomic, you got liquidity, I'll get into that, and then valuation and sentiment. So macroeconomic is everything from economic activity, retail sales, consumer spending, investment, balance of trade, terms of trade, industrial production, capacity, utilization. We talked about demographics, we talked about wage growth, labor market. I mean, I can go on and on and on, but so looking at the macroeconomics, that's when I think of macroeconomics. So growth, basically, where's the growth coming? Where's it going? Is it accelerating, decelerating? Where are the risks to growth? Then there's liquidity. Now, liquidity, I think, is something that my former employers used to obsess about. I think it's less important. I just use that as a catch-all phrase for basically central bank policy and inflation, and obviously the reaction to both of those things. And of course, things like balance sheets, central bank balance sheets, interventions. When the Canadian Bank of Canada buys 86% of all the bond issuance, that's something I would throw into the liquidity bucket. The more liquidity is generally, when you think price earnings ratios rise and you take away liquidity, as you can see what's happening in the housing market, asset prices tend to fall. That's not always true, but in general, that can be true. And then the other 2 pieces, which are slightly less important, but things I always look at, are valuation. Lumped into the valuation piece is earnings. So what are you paying for an asset? How much does that change? When does it change? What drives the change? So things like price to earnings ratio, price to book, price to sales, EV to EBITDA, EV to EBITDA, enterprise value to earnings before interest and taxes. And then obviously I have earnings models that flow into that. So Canada earnings models, if you want to plot Canadian equity markets earnings, you just take the US ISM, manufacturing PMI, you slap on oil, you do the year-on-year change, and I can basically tell you borderline certainty what I think the Canadian EPS growth will be in 12 months. It's sometimes it's very, very easy, other times it's impossible. But so that's the valuation piece. And the final piece is sentiment. I mean, we talk a lot about sentiment here. What's the market feeling, thinking? How do you determine that? There's things like relative strength indicators. Are you overbought, oversold? We talked about spreads. Are spreads expanding or contracting? Flows are an important sentiment indicator. Keith always says, go to the other side of the boat when the boat pitches. That's, going after things that are buying things that are deeply oversold, selling things that are overbought. So that's the sentiment piece. And then as far as what kind of assets, it's stocks, bonds, and currencies. I don't do anything private deals. I'm not smart enough for that. And then commodities, I think I love commodities because I think we just underestimate how powerful and important they are. So anyway, there you go. That's the answer to the question that the person so kindly submitted. I don't know if we're going to do that every week.
Well, no, yeah. By the way, just so plug, I think Rich, I don't know if you announced it, but you will be launching a service for those that can't afford Big Keith's minimums on the investment side. Rich, I think, is launching a happy medium product, which is sort of the retail version of listen, if you wanted to sort of manage your own portfolio, you got 20, 30, 40, 50, 100 grand to work with. You've got a retail based sort of positioning were basically based on, macro fundamentals.
The truth is, I don't think investors, I think at the retail level, I think they get attracted by the weird and the wonderful. Yeah. And I would submit to you that like 90% of people should stay far away from the weird and the wonderful. And I think what I'm trying to do is just to provide sort of a sounding board, maybe some resources that people can, at an affordable price, go and look up. And
I think you're being too humble. I think it was I think it's a great product. I personally read through it, and I know, like, having chatted with a lot of retail investors, that's kind of like what people are looking for. It's just simple asset allocation in a long only format, ETF based.
That's accessible, I think, is the other thing.
Yeah, exactly. So, we'll wrap it up there. As always, we appreciate your support. All we ask is that you share this episode with at least one family or friend to continue to grow the Loonie Hour community. And we'll see you next week.